In a bear market, everyone seems to be a philosopher. In a bull market, everyone seems to be a genius. But the bull market actually just masks the disappearing margins of safety that any investor should protect their downside with. Because when prices soar, investors stop looking at what the company is worth and start looking at what the next person will actually pay. And that in itself is the greater fool theory in action. So in this video, we're gonna uncover what are the strategies that I do to protect my portfolio when the eventual bear market actually comes, and yet not stifle myself from enjoying the bull market run. Hello everyone and welcome back to my channel. My name is John, former engineer turned full-time investor, currently wealth planning director at Phillip Capital, where we help clients with private mandates in global equities. And I'm the author of The Malaysian Multi-Baggers, in which I document 10, 20, 30, 100-time multi-bag companies that have returned shareholder returns over a 20-year period. If you really look at the equities market or share market, share prices are really a reflection of sentiment rather than the underlying business growth, which is a more accurate reflection of reality. If you remember the Glove Mania days, especially the Malaysian stock market in 2020, 2021, 2022, where the glove industry seemed destined to grow, and investors actually ignored the fact that the average selling price that jumped from anywhere from between $15 per thousand pieces to even like $40, $50 per thousand pieces, that these are all temporary shocks in the market, and it's not something that is sustainable over the long run. And true enough, when COVID abated and the world started opening up again, the average selling price actually dropped back even to pre-pandemic, even lower than pre-pandemic days. That is a reflection of what people's sentiment really are. They chase prices, not sustainable earning power, right? Another example I would like to put in, especially in the Malaysian context, would be the data centers. Now, obviously, the big boys like YTL Power, Sunway Construction, they were, instead of focusing, because a lot of the Malaysian infrastructure projects was drying up, after MRT2, MRT3 was delayed, ECRL was kind of delayed, given the Chinese contractors and all that. So a lot of these big boys actually focused on data center, and it was very aligned to the Malaysian government policies. So while you see all these big boys winning contracts and getting sizable hyperscaler as clients, then you see the smaller developer players, and they start announcing like, oh, we're going to get into data center. So there's this particular company, and I have no beef with them. It's just that they seem to be a good example of the Johnny come late on the scenario, because they went into gloves when it was at the peak of the mania. They went into data centers when it's also at the peak of the mania, and this is none other than the Mah Sing Development Group. And if you really think about what is the moat, what is the sustainable earning power, because it's very construction driven, very lumpy. And if you're building a data center, what is the real heart of it, and with the real earning power is not really the shell, but really the utility supply, the server racks that contain more IP that brings out more sustainable earning power, rather than just building the data center shell itself. So if we were to take away from this first point, is really, if you can't explain this business model to a 10-year-old without using big words like synergy or revolutionary or AI, literally your moat and your margin of safety isn't really there. Yes, you may drive earnings in the short term, but will that be able to last over the next 3 years or 5 years? Or is that hype gone as fast as it came, when these stories are actually being spewed out into the investment media, into social media and all that kind of thing? So reality, greed versus reality, I think that's the anchor point number one in any bull market. So the second anchor you should look at while structuring your portfolio is really the structural changes and the macro drivers. Now, what do I mean? A company doesn't exist in a vacuum. There's external structural shifts that can destroy a business model overnight, and a very clear and good example would be the airlines and the logistics industry in light of the US, Iran, and Israel war that we are facing today. So rising oil prices aren't just a cost, it is a structural threat to these kind of industries, because if you look at an airline, 30 to 40% of the cost is actually from jet fuel. And if your margin of safety doesn't account $100 per barrel kind of oil price, you're not actually investing, you're actually gambling on stable energy oil prices. And that's one of the main reasons why I dislike the airline industry, no matter how sexy the story is, because of the structural nature of the industry itself. There's no margin for you to handle any of these shocks. It could come and go as fast as months. You see, I mean, I remember the time in 2015 when we had $120 a barrel kind of oil prices, and Asia X, fearing for their rising operating costs, they actually hedged forward, I think, 6 months to 9 months. And when the oil prices fell again, they were caught on the wrong side of the table because they hedged so much future oil prices at that kind of price. And when prices came down to $60 a barrel, they got hit. So when you are actually investing into certain industries, you need to understand the structural nature of a particular industry and what are the levers or the factors that actually drive a certain industry. For example, if you talk about a press metal, which is a company I've covered in my book Malaysian Multi-Baggers, their cost is a big chunk of their operating cost is actually energy prices, because it is actually converting energy into aluminium. And I think that without them having that long-term PPA, they would not have enjoyed the success that they reach today. Can you imagine if they had to handle spot prices of energy? And no sane operator of aluminium smelter or something that draws a lot of energy, maybe even iron processing, will go into the business if they cannot hedge or cannot have very dominant structural stability in their energy prices. So you see, I think there's another one. So this is examples of industry. Let's look at countries. So let's use China as a context, right? If you look at the latest Q1 2026 GDP numbers for China, I think it was roughly about 5%, right? And if you notice the two tracks, because GDP consists of 4 components, and one of the biggest components, if you contrast that to the US, US has a very big domestic consumption that drives GDP numbers. And whereas in China, the export numbers actually drive a big chunk of the GDP growth. And this actually creates a huge trade surplus for China, because it is a very export-driven economy. And the irony of it all is that in a rising economy like China, where domestic consumption eventually should take over rather than relying on exports, because exports can be disrupted by tariffs, by trade and all that kind of thing, whereas domestic demand or consumption will be more resilient. This is where you can see that China is struggling to match its growth rate of the past, because this growth rate of the past has been driven by the other component of GDP, which is fiscal government infrastructure spending, right? Construction of highways, construction of buildings that really drove China's economic progress 10 years ago. And right now they have to move into a more consumption-driven GDP growth, because if not, then they are very reliant or very exposed to trade tariffs being imposed by, especially the superpowers like US, which will actually drive down their GDP growth. So if domestic demand is rising, then it will be beneficial for China. But if it's not, then it's going to be tough. You can see that already even in global brands that are present in China. Car makers, obviously the Chinese EVs are beating them hands down, but you're also looking at maybe luxury brands like Louis Vuitton, like Hermes. Their sales in China are either declining or actually flatlining. So that is what I mean by understanding the macro drivers for a certain country to anchor your portfolio. right? You will see the rise of mass-stage domestic consumption brands in China because people can't afford it. People are not having wage growth as fast as they had in the past. And that's why when you structure your portfolio, when you invest in different geographies and different value chains, these should form part of your anchor in sizing and allocating. The last but not least, but I feel is also the most important, is the downside protection architecture. So gravity is the only constant in finance. You don't build for it to fall, but when you do fall, you better make sure you have a safety net, because the fall will actually build the bottom, the exit strategy for you, and usually at the bottom. Exit strategy in the sense that, do you cycle out of industries where the growth has stagnated or declined and move into industries that are more resilient? And the sector rotation and how you make sure you're not caught with your pants down when you bought into some hype that in a market correction, liquidity is not there, liquidity gets thin, and you cannot you cannot exit at a profit. So I think if you buy all your stocks in the hottest team right now, which is like AI infrastructure build up and all that, right? That one bet actually is dressed up as 10, but it's actually one bet, because that is very focused on that particular industry. So true safety is actually diversifying into industries that don't move in lockstep. For example, if you're so heavy into semiconductor or AI or whatever, there must be another resilient industry that forms the other chunk of your portfolio, because if a 10% drop on a 70% concentration in your portfolio, that's already your portfolio performance, right? So how you actually should structure it is that what remains growing but selling to you at a lower valuation, you should size it up to be a bigger chunk of your portfolio. And what is a great company growing but priced to perfection is not to say you can't buy it, but you size it as a smaller chunk of your portfolio. Now, it sounds so common sense, but how many people actually practice that in reality? And I think that's why your margin of safety, always the discipline is not easy, because you see this share price being moved up and you talk to your friends, they're making money hand over fist over this PE of 100. I think if I'm not mistaken, Palante had a peak valuation of 600 times PE, and people were still chasing it, and then there was a correction, and then a lot of people panicked and got out. So that is exactly what I mean. I think the discipline to not chase into a rising tide, and like structuring your portfolio that you have a little bit of margin of safety. If you can have even bigger, that's even better, but to have that margin of safety is so critical to make sure your portfolio is resilient to both the bull, not missing out on the bull, and yet at the same time protected during a bear market. So there you go. Let me know your thoughts. How do you currently size a portfolio? Let me know your thoughts about what is your fear about whenever you read the headlines today and the S&P all-time high, Nasdaq 100 all-time high. Are you more of like a risk on, risk off kind of person? That means, all-time high, everything out, all-time low, everything in. But do you think that it's easy to practice that when it's an all-time low, people will really go in, or just say, we'll wait some more because it will go lower? So yeah, human beings are emotional creatures. Let me know what you think in the video, and if you want someone to grow with you with your portfolio, look at your portfolio with a no obligation view, let me know in the comments also below. See you in the next video.